Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are actually telling us with a smile and maybe a raised eyebrow or two. Today we're diving into AEI Income and Growth Fund XXII Limited Partnership's latest quarterly report. And let's just say things are interesting. Stick around because we're going to decode what these numbers really mean for investors. So who is AEI Income and Growth Fund XXII Limited Partnership? Let's get that straight first. They're a partnership focused on buying and renting out commercial properties. Think of them as a landlord on a grand scale, acquiring real estate to generate rental income. Their operations are managed by a company called AEI Fund Management XXI Inc. with the estate of Robert P. Johnson, also playing a role as the individual general partner. Now let's get straight into the money with their balance sheet. This tells us what they own and what they owe at a specific point in time. As of June 30, 2025, their total assets were about $6.18 million. That's down from roughly $6.6 million at the end of December 2024. So a bit of a dip there in what they own overall. Where did that decrease come from? Well, looking at their cash, it dropped from over $94,000 down to about $632,000. That's a pretty significant chunk of cash gone, nearly a third. On the flip side, their real estate investments, which are the bread and butter of this company, stayed pretty much the same. They have about $555 million in real estate held for investment, net of depreciation. This means the actual properties themselves haven't changed much in value on their books, which is pretty stable. It's the cash that's moved out. Looking at what they owe, their current liabilities, meaning what they need to pay soon, are about $127,000. This is down from about $142,000, so they've managed to reduce their short-term debts a little. And then there's partners' capital, which is essentially the owner's stake in the company. It's down to about $6.05 million from $645 million. This drop in partners' capital is directly related to the decrease in cash and assets, and it also reflects things like distributions paid out to the partners. Now, let's talk about how they're making money or losing it with their statement of income. This is where we see the revenue and expenses over a period. For the first 6 months of 2020-25, they brought in about $219,843 in rental income. That's a tiny increase compared to the same period in 2024, which was $219,039. Barely anything changed there, just a few $1,000s more. But here's where things get interesting. Their expenses are a big deal. Depreciation and amortization, which is basically the accounting way of saying the buildings and other assets are getting older and losing value, cost them about $140,373 for the first half of 2025. That's a pretty big number. And it's lower than in 2024, which was around $373 for the first half of 2024, which was around $57,818. So they're booking less in asset value loss, which sounds good. But it's also a non-cash expense. When you add up all their expenses for the first 6 months of 2025, they spent about $1,758 compared to the same period in 2024, which was $258. So expenses are down, which is a positive sign. And the result of all this rental income minus expenses for the first half of 2025, they made a net income of $11,210. That sounds small, doesn't it? But it's a big improvement from the same period in 2024 when they actually had a net loss of $34,977. So they've gone from losing money to making a little bit of money. That's progress. For the average limited partner, this translates to about 95 cents of net income per unit for the first half of 2025, compared to losing about $2.95 per unit in the first half of 2024. So for every unit you own, you're much better off this year. Now let's look at cash flow, which is the lifeblood of any company. How much actual cash is coming in and going out. Things can look different when you focus on cash. For the first 6 months of 2025, AEI Income and Growth Fund XXI generated $27,483 in cash from its operating activities. This is a good increase from $99,123 generated in the same period of 2024. So the core business is producing more cash, which is what you want to see. But then we see their financing activities. This is where they're raising money or paying it back. And boy, are they paying it back. In the first 6 months of 2025, they spent a whopping $278 repurchasing partnership units. That's a huge amount of cash leaving the company to buy back their own shares essentially. They also paid out $138,440 in distributions to partners. So when you combine those repurchases and distributions, you get a big cash outflow. For the first half of 2020, $98 for financing activities. This massive outflow for financing, especially the unit repurchases, is why their cash balance took such a hit. The net change in cash for the first 6 months of 2025 was a decrease of $28.25. Even though they made more cash from operations, they spent way more on financing activities, leading to that lower cash position we saw on the balance sheet. Let's dig a bit into the partner's capital itself. This table shows how the owner's stake changes over time. At the start of the year, December 31, 2024, the total partner's capital was about $6.45 million. They declared distributions of $69,220, and the actual net loss for that quarter was quite small, just $1,727. Then comes that big event we saw in the cash flow statement. On April 1, 2025, they repurchased 486.25 units for $26,939. We can see this explicitly here, reducing the limited partner's capital by that amount, and also a small portion by the general partner. The net effect of all this activity, including a net income of $12,937, brought the total partner's capital down to $6,058,927, brought the total partner's capital down to $6,058,921. As of June 30, 2025, these notes are where the company gives us more color on the numbers. First off, they mention that these statements are unaudited and that they've condensed some information. They advise you to read this along with their annual reports for the full picture, standard stuff for interim reports. They also clarify their structure. AEI Income and Growth Fund XXII Limited Partnership is the main entity, and its operations are managed by AEI Fund Management XXI Inc., which is a subsidiary of AEI Capital Corporation. AEI Fund Management Inc. is the one handling the administrative chores for the partnership. There's a payable to AEI Fund Management Inc. This is money owed for services rendered, and it's stated to be non-interest bearing and unsecured. Basically, they owe their management company some money, which is normal. This note provides more detail on distributions. For the first half of 2025, they declared distributions of $137,054, a slight decrease from $134, a slight decrease from $38,440 in the same period of 2024. The limited partners received the bulk of these, with the general partner getting a smaller slice. Interestingly, they specifically mentioned that the repurchase of those 418 a smaller slice. Interestingly, they specifically mentioned that the repurchase of those 418 a smaller slice. Interestingly, they specifically mentioned that the repurchase of those 418 a smaller slice. Interestingly, they specifically mentioned that the repurchase of those 480 6025 units for $69,139 on April 1, 2025 was done according to the partnership agreement. This repurchase increases the ownership stake of the remaining limited partners, which is a common outcome of buybacks. Now, this is a big deal. In July 2025, just after the period covered by this report, they entered into an agreement to sell 65% of their interest in an Advance Auto Parts store. The sale closed on July 29th, with the partnership receiving approximately $925,000 in net proceeds. This sale resulted in a gain of about $24,000 in net proceeds. This sale resulted in a gain of about $204,000 in net proceeds. This sale resulted in a gain of about $24,000 in net proceeds. This sale resulted in a gain of about $2,000 in net proceeds. This sale resulted in a gain of about $24,000 in net proceeds. This sale resulted in a gain of about $24,000. This is a significant event that happened right after the reporting period, and it will impact their future financials positively with that gain. This section is management's narrative explaining what's going on. They caution us about forward-looking statements, which are basically predictions about the future. They mention things like market and economic conditions, tax consequences, and tenant defaults as factors that can affect their business. Management notes that rental income is expected to be around $41,18,000 for the full year 2025. They attribute the slight increase in rental income for the first half of 2025 to one property having a rent increase, which was partially offset by another property having a rent decrease. They also point out that expenses from affiliated parties increased slightly due to the timing of tax and audit services. They also saw a nice bump in interest income, going from 27.1 TRM to Hyvernition Device Forty 14.25. Thanks to higher average cash balances, it fall well 18.25 compared to 2020-24, mainly due to reduced property management expenses. Expenses from unrelated parties increased slightly due to the timing of tax and audit services. They also saw a nice bump in interest income, going from 2007 to 2025, thanks to higher average cash balances. This part is all about cash. As we saw, their cash balance decreased significantly. Management explains this is because distributions paid to partners and unit repurchases were higher than the cash generated from operations. The increase in cash from operations is good, but the unit repurchases are clearly a major drain on their liquid assets. They mention that continuing rent payments and proceeds from property sales should be enough to cover ongoing distributions and obligations. The big sale we talked about in July definitely bolsters this. They state that they have no material off-balance sheet arrangements, which means everything important is right there on their financial statements. Good to know they're not hiding anything in the shadows. As a smaller reporting company, they are not required to provide this detailed breakdown of market risks. This section deals with their internal controls. Management, including the president and chief financial officer, have reviewed their disclosure controls and procedures and have concluded that they are effective. This means they believe their systems are in place to ensure accurate and timely reporting of important information. Good news here, there are no material legal proceedings currently affecting the partnership. Not required for a small reporting company, so no new risks to report from this section. This covers share buybacks. The partnership agreement allows limited partners to offer units back to the partnership for repurchase. The purchase price is set at 90% of the net asset value. They detail the buyback on April 1, 2025, where they purchased 486.25 units. This is specifically mandated by their partnership agreement. In April 2025, they bought back 486.25 units at an average price of $553 and $53.53 unit. It's interesting that the partnership agreement mandates these repurchases, and they can do up to a certain percentage of outstanding units each year. This adds a layer of predetermined cash outflow that investors need to be aware of. This just lists the certifications and other documents that are filed along with the report. It includes certifications from the President and CFO regarding the accuracy of the financial statements, which is a requirement under the Sarbanes-Oxley Act. And finally, the signatures. This is where the authorized officers of the partnership, in this case Marnie J. Nygaard as President and Keith E. Peterson as Chief Financial Officer, sign off confirming the accuracy of the report. So what's the big story here for AE Income and Growth Fund XXII Income and Growth Fund XXII and Limited Partnership? Well, the core rental business is chugging along, slightly improving its income, but the real drama is in how they're managing their capital. They've significantly reduced their cash reserves by aggressively repurchasing partnership units. This shows a commitment to returning value to existing partners by increasing their stake, but it also means less cash on hand. The subsequent sale of a property in July for a good gain is a positive development that will help offset some of that cash drain. What are the risks? The heavy emphasis on unit repurchases, even if mandated, can leave them less flexible if unexpected expenses arise. While the asset management is handled by affiliates, it's always good to monitor those related party expenses. The market value of their real estate can also fluctuate based on broader economic conditions. But for now, their properties are being held steady on the books. Looking at the financial tables, it's clear that they've shifted from a net loss to a net profit, which is a fundamental positive. However, the nearly $300,000 cash reduction is a stark reminder that operational profits don't always translate into a healthier cash position when significant buybacks are happening. The upcoming property sale is a bright spot that will boost their financials in the next reporting period. My take is that this is a company actively reshuffling its capital structure, prioritizing a reduction in outstanding units. This can be a smart move to increase value per unit for remaining shareholders, but it requires careful management of cash flow. The business itself seems stable, with rental income holding steady, and the recent property sale is a strong indicator of future positive performance in the short term. The key will be balancing these repurchases with maintaining adequate liquidity for ongoing operations and other potential investments or distributions. Alright, that's our breakdown of AEI Income and Growth Fund, XXII Limited Partnership's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.